How's your startup? Okay. Come by and chat after the class. We'll do an updated valuation. Yeah, that's a good idea. That's a good idea. Yeah. Let's hold on. But let's, I mean, in a sense, it would be good to meet at the beginning of the summer because then I can give you indicators on things that you might want to start keeping tabs on that are input into your estimates, right? Which is what percentage of people do you call who actually call back? I mean, things like that, right? Because those are the metrics that will allow you to build up a kind of valuation that actually stands up to scrutiny. Exactly. Because that's going to tell you how much work it is going to be to scale up, or how little work it's going to be to scale up. So those are the numbers that, if you know early enough, you can start to keep tabs on, because it's good to know those numbers later in the process when somebody says, well, okay, you're going into a new city, you're going to call 100,000 businesses, how many will call you back? And you can then say, well, this is what happened in New York and LA, and this is what we can extrapolate. Did it come through? The slides come through? Did the slides come through? Did the slides? Yeah.
Could I give that quick message?
Yep. Wait about a minute. Wait.
Yeah.
Wait 1 minute.
Okay. She's a girl from the poster. We need her. Good morning, everyone. For those of you who don't know me, my name is Gabriel. Along with Rodrigo, I'm co-president of Lava. Yeah. And this is Mapa, who's the VP of events. We just want to give you a quick reminder that this Friday we're hosting the Lava party at Hudson Terrace. We're going to be selling tickets outside of class right now at noon and the table. So we would appreciate if you guys could come and buy your tickets, because it's going to be one of the last opportunity to get them. And just a reminder, it's going to be the last event of the year. It's going to be on Friday after the motor ends exam. So I think it's going to be a great day for you guys. So we would love if you could come. Thank you.
Okay. So how many of you did not sleep last night? And I knew that the summaries that came in at 4:35, I wasn't up to see them. When I got up this morning, I checked them, and then you either went to sleep really early and woke up really early, but knowing that that's not the way the world works. At least a few of you stayed up late, and your summaries kind of reflected that you hadn't slept in a while. So what I'm going to do this is actually going to be a strange session. It's a session which is both, it's going to be part review, part magical mystery tour, part revisiting painful parts of your project. So it's kind of, I'll use your project to kind of review the entire class. So let's go back to the very beginning. Okay? Very first day of class, I said, I'm going to ask you to do something on a company that's going to take up the entire semester. And everything we do in this class, you will try on your company. And I'll give you the genesis of this torture that I've devised for you. Okay? When I first started teaching corporate finance, I was told to do it using cases. And I tried it once, and I said, never again. This is such an incredibly artificial way to look at business. To give you something that happened 20 years ago, construct a narrative for you, you know what the ending is, and then ask you, what do you think the ending should be? That's what, at least in corporate finance and valuation, it's never made sense for me to think about the past. It's got to be right now, it's got to be happening. And that comes with its own set of pain, as you discovered. So let me state a few things that you probably found in the course of this project. The first is you discovered how few facts there were on the ground, right? Everything is almost an opinion, including much of what you see in your financial statements. You look at operating income on your 10K, you get a number. You go to Capital IQ, you look up the operating income for your same company, you get a different number. You go to Yahoo Finance, you get a third number. And you had to decide, right? And sometimes you tried to sound me out, and I pushed it back on you saying, it's your decision. You have to make that judgment. Right? The second factor that you probably ran into is how messy the real world is. No number ever ends in 3 zeros. Have you noticed that? It's nice if people said, I have 6 million in revenues, it's actually 6 million. Everything has 3 decimals and it keeps shifting on you, you know. So when you look at that reality, you're also going to find that some of you, and you took my advice, you picked a company that was making money at the start of the semester, you discovered magically by the time you got to the project, your company had gone from being a money-making company to a money-losing company. That created a lot of angst, but there's really not much you can do about it. That's the way the world works. Right? And often, and at least 3 of the companies in this class got acquired during the course of the semester. It can happen. And I said, stay with the company because the acquisition process takes time, so it doesn't mean. In fact, it might make it more interesting to see what about this company made it attractive to acquirers. The third unpleasant fact is that models don't compute values. You do. Okay? And these are the emails that would get to me the quickest because you'd say, your capital structure spreadsheet. And already I knew where this was going, right? Computed an optimal of 0% for my company. And the implicit message is, what's wrong with your spreadsheet? And of course, when you get to the valuation, this really went haywire, right? I'm getting a really low value for the company using your spreadsheet. What did you do wrong? And I think it takes a while. I mean, I understand where you're coming, because when you put numbers in the spreadsheet, it looks like the spreadsheet is doing magical things, but it's not. It's actually a very plebeian spreadsheet, especially the valuation spreadsheet. Here's what I do. I take your historical data, which you gave me. I take 3 big inputs, revenue growth, operating margin, and sales to capital that you gave me. And all I do is grind out the numbers and say, this is what the value is. And if you don't like the value, guess what? Something's got to change, and it's not going to be the spreadsheet. It's got to be your revenue growth. Or your and it's tough because initially you hate to let go of historical data. So for a lot of people who used historical data and just pumped it into their revenue growth and margins, you might have gotten strange numbers for your valuation. But I hate to say this, but it's not my fault. Those are the numbers, and if you want to change the value, those are the numbers that have to change. So it's not that the spreadsheet is doing something incredibly mysterious in the background. It's just taking those inputs and driving your value. So as we go through these next few slides, the next 32 slides, lots of slides, what you're going to see are the summaries you send me. And I actually collected both the undergraduate and this class together, so there are 500 summaries out of, I think there are 600 people in the 2 classes, and already my mind is thinking about 140 projects I have to start grading this afternoon, but that's my problem. Your problem is over, my problem just begins. So, but out of the 600, I think 500 gave me complete summaries, others had partial summaries. So what you're going to see are the results that you sent me for your companies, and I'm going to use the framework of the class to kind of present those results. So at the start of this class, I spent, 4 sessions on corporate governance? Remember, we didn't talk about number. We talked about the conflicts of interest that drive the modern corporation. And I broke those conflicts into 4 linkages. The first is the link between stockholders and managers. And we talked about the fact that in the real world, stockholders, the power that stockholders have over managers is limited, because the 2 devices that we think of for that power, annual meetings and board of directors, are not that malleable to shareholders. And then we said, because of that, managers often put their interests over shareholder interests, and we kind of left it there with examples to come. Then we talked about the fact that if you lend money to a company and you don't protect yourself, you get Nabiscoed. Remember the Nabisco phenomenon, where if you lend money, I don't care who you lend the money to, if you don't protect yourself, you're asking for trouble. Third, we talked about the interplay between companies and markets. And this is a dance we've danced all semester. We pay heed to markets, but then we step back and say maybe markets can be wrong. So in the real world, companies don't always reveal information to markets honestly and on time. And some of you discovered this in the context of your own company. As you went through the annual report, you discovered what companies were holding back. You could, I mean, let's face it, companies know where they get their revenue. So why the heck don't they break them down better? They know what expenses are operating and what are extraordinary. Why don't they do a better job? So some of this is by design, and markets did some strange things on your company during the course of the semester as well. And finally, we talked about social costs and benefits, something we never really grappled with in this class, and that was intentional. Because social costs and benefits have a personal component. What you think are big social costs and social benefits might not be the ones that I think are big social costs and benefits. So I'm not saying they're not important, but if I impose what I thought were important costs and benefits, it wouldn't fit into your framework. So if you're running a business, of course you got to bring in social costs and social benefits, but it's by your design. So that's the framework we started with, and one of the first questions I asked you on your company. And I couldn't think of, I mean, I could have asked you a more complex question, give me your ISS score, but half your companies you couldn't get, you have no idea what an ISS score is. Don't freak out. If you didn't get one, it's not that your project is incomplete. You don't have to run and do anything. But for some US companies, there are these scores in corporate governance. So I made it much simpler. I said, tell me in your company whether shareholders have no power, some power, or lots of power. And that's for a 0, 1, 2. And then I broke down your responses. So this is the pie chart of what you told me. So according to you, 33% of your companies, you had no power. Shareholders have no power. In 42% of companies, they have some power. In about 23% of companies, they have lots of power. And then I had all these other numerical inputs that I had no idea, like 3, 5, 7, 11. I don't know whether these were your keyboard slipping or whatever it was. I just put it into that 2% saying, I have no idea what you're telling me, but I'll wait to read your report. Maybe you have something magical happening, because the 3s especially were interesting. Maybe you added the 1 and the 2, moderate. So whatever it is, I'll be interested. But I have a feeling it was just late in the evening, 3 came through. I did not ask you this question, but this is a question that you probably had to confront somewhere during the course of the semester, which is, who's your marginal investor? I mean, that's why you look at the top 17 investors. Not always an easy question to answer if you have a small, closely held company, but if you have a large market cap company, this question was pretty straightforward. A marginal investor was probably some kind of institutional investor. It's not the name I'm looking for, it's a type of institutional investor. I don't care whether it's State Street or Fidelity, because ultimately the reason I care is if your marginal investor is diversified, the way they measure risk changes essentially when I look at the cost of equity. That's why we look at this question. So I will do this with your class. Once I read the reports, I'll keep track of what you tell me. But in the spring 2015 class, when I kept track of it, here's what it looked like, broken down by type of company. Among small companies, so they basically, the first purple line is institutional, the second is individual, the third is insider. First I compared small to large. Among large companies, far more institutional investors as marginal investors. Among small companies, you did get a fairly large subset of companies where the marginal investor was not institutional, was an individual or an insider. And that makes your job a little more difficult, right? Because when you think about risk, then you can't just think about beta, betas, whatever they are. You have to think about at least total risk. Even if you don't use it, you have to think about maybe in this company, the family, I think Constellation Brands, the family runs the company. You got to ask yourself, when they make decisions, are they thinking about what's good for the institutional investor, or are they thinking about what's good for them as a family? That's a dance that they have to dance, but that's the reason you care. In fact, I also broke down geographically, and you can see in emerging markets, you get a much larger subset of companies where either insiders or institutions, kind of making your job, insiders or individuals end up being marginal investors, which makes your job of assessing cost of equity much more difficult. What I'm laying the groundwork for is if you go back into an emerging market and you're advising a family-run company, you plug in a beta, you come up with a cost of capital of 9%. You tell the company your cost of capital is 9%. They're going to say, no way. Our cost of capital is at least 18 or 20%. And rather than telling them you're wrong and keep going through the equation over and over again, step back and think about what they perceive as risk, because that might explain the difference. So now let's assume you've made that marginal investor judgment. you come to the cost of equity and the cost of capital. Let me lay the groundwork. In the cost of equity, the first thing you need is a risk-free rate. So I ask you to pick a currency and stay true to that currency all the way through. Easier said than done, because you can see how easily you get distracted by other currencies. And for something to be risk-free, it has to be long-term and it has to be default-free. So if you're working in the US dollar, you can say the T-bond rate is risk-free, but remember that's based on the assumption that the US Treasury has no default risk. If you're working in euros, you're going to use the German euro bond rate or the ECB rate as your risk-free rate, because it's the closest thing to something default-free you can find. But if you're working in a local currency, whether it's rupees or rupiah or nominal reals or Mexican pesos, your job got a little more messy because you had to clean up that government bond rate for default risk. The second input you need is a beta, and I want to kind of step back. Betas are not just numbers that come from regressions, they measure your exposure to market risk or macroeconomic risk. So a biotechnology company will not have a high beta because much of the risk you're exposed to as a biotech firm reflects the fact that the FDA might not give you approval. That has nothing to do with the rest of the market. And when we thought about what drives betas, it comes from three decisions you make. What kind of business are you in? The more discretionary your products or services, the higher the beta. The second is how much do you have as fixed costs? The more fixed cost you have as a company, the higher your beta, because everything gets more volatile, and the more you borrow, and that's why we do the levered, unlevered beta dance, the higher your beta will be. And then we talked about equity risk premiums, and the key thing to remember about equity risk premiums is they have to reflect where you do business, not where you're incorporated. So if you're, it doesn't matter if you're a US company or a European company, we have to stop thinking about companies based on where their headquarters are and start thinking about where they get their revenues. So here's what the first number I asked you for. What's your beta? And if you remember going back about 12 weeks, we went through this question of what's the right way to estimate betas. And we went through the standard textbook approach. Run a regression, take the slope of the line. The slope of the line is the beta. The limitation of that approach is it's one pass of history. You know what I mean by one pass of history? Last 2 years, last 5 years. Strange things can happen during that period. So when you look at a regression beta, not only is it backward looking, but it's extraordinarily noisy. And the alternative I offered you is why look at one regression beta? Why not just look at the business you're in? After all, betas measure market risk, macroeconomic risk. Look at the business you're in. Build up to a beta for your company. That's a bottom-up beta. Adjust for your leverage, because obviously your debt-to-equity ratio can be very different from every year. So that choice between top-down and bottom-up beta. And did I make my biases pretty clear about which one I was trying to push you towards? I think it was, because here's what you told me. So my job, my objective one day is to have a pie chart which is just one color. I'm getting closer and closer each year, so I have to strengthen my sales pitch even more next semester. But basically, out of your 500 companies, 95% you told me use bottom-up betas. I have no idea exactly how you built up the bottom-up betas. In 4% of the companies, you used a regression beta. Here again, besides B or R, I see all kinds of other alphabets. I have no idea what they mean. So I'll have to wait and see what's involved. But I can almost predict. I haven't read your reports. I'm not that psychic yet or psychotic yet. Okay? But my guess is one of these three, if you stayed with the regression beta, one of these three reasons was probably the reason you used. The first is your company is so unique you could not really find companies like it. And I'm going to, I'll keep an open mind. It is possible your company is so unique that the only way you can get a beta is with a regression beta. The second is that your company is only one line of business. This argument really doesn't hold up. You have until 5 o'clock to fix your project anyway. Right? The problem is you've got to give me a different reason, so you can't go back to a bottom-up beta. That's too much work. So give me a different reason. The reason a single line of business doesn't hold up is the biggest argument for bottom-up betas is not that you're weighting betas across business. It's the law of large numbers, right? So if you're a steel company, I can still beat one regression beta with an average of 100 regression betas. So if that's your only line of defense, it's a pretty weak one. And the third one is, and this is, I think, something that many of you wrestle with. You had a regression beta one number and a bottom-up beta that was very different. You're saying, but they're very different. Let me ask you a question. If most of the time regression betas and bottom-up betas gave you the same number, why would we go through this process of estimating bottom-up betas? The very fact that we go through bottom-up betas must mean that most of the time they're going to be different, and you have to make a choice. So don't say, because they're very different, I'm going to go with the regression beta, because the entire reason for doing bottom-up betas is precisely to replace those very different regression betas with betas that make sense. There's a fourth reason, which I'm willing to accept, which is, remember we talked about intuitively coming up with what your beta, so you have a luxury retailer, if your bottom-up beta came in 0.7, you say, you know what, that doesn't make sense. I'm a luxury retailer, my products are discretionary, I'm going to go with a higher beta. And the regression beta makes sense. I think that I can live with, because at least you're reasoning your way to a higher beta using the regression beta as a peg, but it's really the intuition that's driving you there. So that was the beta choice. And here's what your beta distribution looked like. As we go through each of these numbers, I want you to keep tabs on what the typical company you're analyzing looks like. The median beta for your companies was 1.09. The average beta was 1.13. So that's a distribution of betas. So your typical company in this class is riskier than the average company. Okay, so that's the first piece. That shouldn't come as much of a surprise. You didn't want to do a boring company, so odds are you stayed away from boring companies. You're going to end up with higher betas. Then I looked at your Jensen's Alpha. Remember the cutoff for Jensen's Alpha? Below 0 means you did worse than expected. First, the Jensen's Alpha measures how well or badly you did after adjusting for risk and after adjusting for the market. The average Jensen's Alpha across all stocks is 0. Your median Jensen's Alpha was about 2.5%. The average was much higher because you had a few outliers. Remember, Jensen's Alpha can be a huge number. You invested in Tesla 3 years ago. Your Jensen's Alpha could be 100%. So your typical company did better than the market. Why do you think that is? In fact, 3/4 of your companies had positive Jensen's Alphas, 1/4 had negative Jensen's Alphas. What is it about the selection process that you think might have tilted you towards positive Jensen's Alphas, Greg?
Some survivorship bias.
And how did I kind of induce that into the project choice? What did I say you had to pick between companies? Money-making companies. In a sense, because I forced you down into the money-making company route, you can already see I've tilted you towards a positive Jensen's Alphas. It doesn't guarantee it, because some of your companies made money and still had negative Jensen's Alphas, but it tilts the distribution towards. So your typical company was riskier than average and performed better than the average company. Then I looked at then I asked you to look at the Rsquared. Here again, the median Rsquared across your companies was about 21%. The average was about 24%. The median for the market is about 35%. So your typical company not only was riskier than the market, it not only had a better Jensen's Alpha than the typical stock, it also gets more of its risk from specific components. Why? Because the interesting companies are companies like Shake Shack, right? And Pandora, and these are companies where interesting things are happening, but they're happening at the company level. So those are the numbers that go into your cost of capital. Risk-free rate plus beta times an equity risk free. We came up with the cost of equity. That cost of equity becomes an input into the cost of capital. And there I have to get two other numbers to get this game going. First is an after-tax cost of debt. And that after-tax cost of debt meant that you had to go past looking at historical numbers. The question we're asking is, what does it cost me to borrow money long-term today? Which meant that you start with your risk-free rate, and whatever currency you picked, same currency you did your cost of equity in, and then you added a default spread. For some of you, that process was simple because you found a rating for your company. But don't get too comfortable with actual ratings, because ratings agencies do screw up. That's the problem with staying with an actual rating, is you're told it's bad, but only too late. For the rest, if you could not find an actual rating, you had to estimate a synthetic rating. And I'm sorry that I did not wrestle through this process in more detail in class, but for those of you with leases, this meant a little bit of work, because if you just use interest expenses from the income statement, you're not capturing the lease effect. So if you use any of my spreadsheets, it does it for you, but it happens in the background. But for those of you who are only lease commitments, this came front and center, because your interest expenses looked like they were 0. Your company looked like it had a AAA rating, which made no sense until you factored in those lease commitments. So that's a synthetic rating that gave you a pre-tax cost of debt. Of course, you had to apply a marginal tax rate to that. And that marginal tax rate has to be the tax rate. I asked you to use the country you were in because it makes your life easier. But if you're a multinational, think about it. You're in 15 countries with different marginal tax rates. You're really going to go to the country with the highest marginal tax rate, assuming you have enough income in that country, which means a surprising number of global companies are getting the tax benefits of the US marginal tax rate. Why? Because if you're Nestle, you're going to find a way to borrow money primarily in your high marginal tax rate countries. Again, I don't want you to wrestle with that, but something to think about when you think about cost of debt. It's not going to make a big difference in your cost of capital, but it can make that marginal difference that tilts your project from a bad project to a good project. And the weights on debt and equity should be market value weights. For the equity, that's pretty simple. Okay? Though in theory, the market value of equity should also include the value of options you've granted, which is a mess because you really have to then price those options. So I'm going to let that go now, but in the valuation class, we're going to talk about how to bring options in, because for a company like Cisco, it can push up your market value of equity because you have those options outstanding. For the debt, it was a little messy because you had the book value of debt, and you had to make it into market value. But if you had a maturity for your debt, that was relatively simple. If you did not, well, you had no choice but to use the book value of debt or assume a maturity and work out the market value of debt. So here's what your debt ratios look like across your companies. Okay? Your average, I forgot to put the box up there, your average debt ratio was about 25%. Your median was about 23, 22%. Okay? And you can see most of your companies were under-levered companies. So add that to the list. Your typical company had a higher beta than the average company, did better than the average company, got more of its risk from firm-specific components, and also had relatively little debt. Okay? I think in your sample, 55 companies had zero debt. Okay? Not even leases. Or you couldn't even find the leases because they were emerging market companies, didn't give the table, but there were a fairly large subset of companies with no debt. We'll come back and talk about are those companies automatically under-levered, because not necessarily. Many of your companies had no debt, and you concluded they should not have any debt given what they had as operating income. So that's the cost of capital and the cost of equity, and those become your investment hurdle rates. That's what you want to beat as a company. And I suggested you take a snapshot of your company where you look at what they actually make on their projects and compare them to what they need to make. And here the consistency issue again comes up. If you're looking at the cost of capital for a company, the return you should be computing should be return on all of your capital, which means you're looking at pre-debt earnings, operating income. And you're going to divide that pre-debt earnings, operating income, after you computed the taxes, by the invested capital in the company. And the invested capital is it is the only place, this is the only page in the entire project where you're focusing on book values, because you're looking at what you've actually invested in projects. You come up with the return on capital, you compare that to the cost of capital. If you earn more than the cost of capital, at least based on the snapshot, you're doing better than expected. If you earn less, at least based on last year's numbers, you did worse than expected. So one comparison is on the capital base. The other way you can run a comparison for your companies, you can do everything on an equity basis. You can look at the net income you make as equity investors, divide that by the book equity. Okay? That return on equity gets compared to a cost of equity. Again, you're computing whether your company did better or worse than expected based on that comparison. So here's what your return spreads look like across your companies. The average, so the typical company in your, at least picked in this class, earned well above its cost of capital, which we already know makes it unusual because 55% of companies globally last year earned less than the cost of capital. You earned about 13% more than your cost of capital, about 13% more than your cost of equity as well. But the median number for the cost of capital spread was a lot lower than the median number you got for the equity spread. And that's not unusual, because if your company is beating its cost of capital, on an equity basis, the spread's going to be larger because of that leverage effect. Okay? Couple of things on this particular calculation. To get a return on equity, I need a book equity. Book equity can become negative. What does it mean? Really nothing, but it just means you can't compute a return on equity. The book equity becomes negative because you've had a series of losses that have wiped out your equity. It's not the end of the world. About 1 in 9 US companies has negative book equity. There are parts of Europe where you can't have negative book equity. You're actually required to raise equity if your book equity falls below zero. But US companies, it's not atypical. So when that happens, you can't compute the return on equity, but you can still compute the return on capital. Okay? Let's talk about the optimal debt ratio. So at this stage, you've looked at the cost of equity, cost of capital of your company, the existing debt ratio, you've looked at the project and say, are these projects collectively good projects or bad projects? Then I said, what's your optimal debt ratio? And it's true, I've kind of pulled you into that spreadsheet partly because the mechanics of doing it manually, it's not difficult, it's tedious. You can do that debt ratio like we did in class. The optimal debt ratio, the median that you got was what that banker told me you could use as a rule of thumb. So maybe it wasn't that off, it was 40%. But it's a huge distribution. In fact, there were 65 companies out of the 500 where the optimal debt ratio was 0%. So if your optimal debt ratio was my company should not borrow money, you had lots of company. Basically because these were young companies, low operating income, they really shouldn't be borrowing money. Okay? Yeah, and if you look at, I think there were at least 8 or 9 companies where the optimal debt ratio was 90%. Some of them didn't surprise me, a couple did, so I've got to take a closer look at what's going on because sometimes it can just be that something got thrown off in the inputs. But a big spread of optimal debt ratio. Your typical company was under-levered by about 10%. So in addition to being a company which was riskier than average, did better than average in terms of a Jensen's Alpha, was earning positive excess returns, your typical company also has debt capacity. Okay? It's under-levered by about 10%. The most under-levered company in the sample actually had an actual debt ratio of 0% and an optimal of 90%, and the name of the company kind of surprised me, so I'm going to hold off on mentioning the company until I look at the numbers. Okay? There's one company where the optimal debt ratio was actually 68% higher than the optimal. It's a company that this is, remember that part of the framework said, should you do something quickly? In this case, yes, you should do it right away. Right? This is beyond the pale in terms of safety. So you can again see that the typical company, there were more under-levered than over-levered companies. About 60% of the companies came in as under-levered, 40% came out as over-levered. Right? Then I ask you, what kind of debt is right for you? You're saying, what if my company doesn't have any excess debt capacity? You can still look at the existing debt. And even if you have no debt capacity, you have an optimal debt ratio of 0, it doesn't mean you can't look forward and say, when my company can borrow money, this is the kind of debt they should use. And the basic rule I suggested was match up your debt to your assets. I did give you that regression framework that some of you tried and you discovered very quickly how noisy it was. You were getting strange looking numbers, and I warned you that that could happen. So I gave you the bottom-up numbers as well. But essentially in the regression framework, what I looked at was how sensitive your value as a company was and your operating income was to changes in different variables. I started by looking at how sensitive your firm value and operating income were to changes in interest rates. What does it tell me? It tells me for every 1% change in interest rates, how much my firm value drops. That becomes a measure of my duration. Then I looked at how sensitive your firm value and your operating income were to GDP growth. Why? Because that tells me how cyclical your company is. Then I looked at how sensitive your firm value and operating income were to inflation. That tells me something about your pricing power. And I looked at the final regression. I looked at it against exchange rates to see whether a stronger dollar helped you or hurt you. Again, what I'm doing is using your own historical data to get an imprint of, are you affected by these variables? And if so, how can I bring it into my debt? Then we got to the dividend section. And remember, the way I describe the dividend section is more than any other aspect of corporate finance. This is built on trust. And really at this stage in the project, I was asking you, given everything you've done in the project in your company so far, do you trust the management of this company? You're saying that's a subjective judgment. It is. And dividend policy, in a sense, is a subjective judgment. That's why it can shift on a dime. You can go from trusting a company to not trusting a company in a matter of weeks or months. And when that happens, of course, a company is shocked by what happened, but it can happen, it happens all the time. So in this case, the way I said that might make sense to start this discussion is to look at what your company could have paid out. in dividends, potential dividends, the free cash flow to equity. So let's go through the intuition in this process. You start with your net income. Why? Because as equity investors, this is what you get to claim as accounting income. You add back depreciation and amortization. Why? Because it's a cash expense that lowered your income, but it's still there. You subtract out your reinvestment needs. That includes capital expenditures and working capital needs. And then if you have debt payments, you got to make those as well. But the bonus there is if you borrow money to pay that debt, you can use that as a cash inflow to cover some of the debt payments. What you're left with is your free cash flow to equity. In, I think, about 18% of your companies, your free cash flow to equity was negative. So essentially, in those companies, you can already conclude, hey, this company, based on what it did last year, or its free cash flow to equity, should not be paying dividends. And that's why I suggested expanding your horizon, because it might be just 1 year that you had negative free cash flows to equity. But here's basically what the distribution looked like. And unlike the rest, where there's this middle, you can see that dividend policy is, this is the dysfunctionality, right? You're at either extreme. At one extreme are the companies that don't pay dividends, and this includes buybacks as well, and don't buy back stock. And there were at least 80 companies which returned no cash to their investors. Some of those 80 had negative free cash flow to equity, about a third of those 80, but the rest were choosing to build up cash. In fact, everything through 99%, which is the rest, is a cash buildup. 156 companies, which is about 30% of companies, pay out more in dividends and buybacks than they got in as free cash flow to equity. Could they be crazy? Yes. But it could also mean that they're trying to push up your debt ratio, because if you're trying to push up your debt ratio over time, you will in fact go out and pay out more in dividends. So when you look at your company, you say, how would I know? This comes after capital structure, right? So you have a sense of whether they're under-levered or over-levered. There is that connection to be made to dividend policy. Right? And then we get to valuation. And I'll cut you a lot of slack on the valuation section because it comes at the end of the class. You're not feeling particularly motivated to kind of attack it with any depth. But you also don't feel confident enough to go in and make estimates, right? You're saying, I don't know enough. What you're going to discover is you're going to know just as little 5 months from now, but you're going to feel a lot more confident that everybody else knows just as little, which means on a relative basis, you're not as ignorant as you thought you were. But that's a process you got to get through. And that's part of the valuation class, is preparing you for the fact that the rest of the world might be just as ignorant as we are about our judgments, and you still have to make your judgments. But here again, I said be consistent. And there were two ways you could approach valuation. You could focus on just the equity in the business and try to value the equity. What does that mean? Well, you take cash flows to equity, which can be free cash flow to equity, or if you have a bank or a financial service company, just the dividend. You discount those free cash flows to equity at a cost of equity. And when you talk about growth for these companies, it's got to be growth in equity income. And if your company is in steady state, that growth in equity income has to be a product of how much you reinvest back into the company and how well you reinvest. Your retention ratio times the return on equity. So your equity valuation, everything is equity focused. Your cash flows are equity focused. Your growth rate is equity focused. Your discount rate is a cost of equity. What you get as a present value will be the value of equity. If you're valuing the entire business, your focus has to shift. Your cash flows are pre-debt cash flows, right? So that's why we start with operating income. You do subtract out taxes and reinvestment needs, but you discount those cash flows now back at the cost of capital. And what you get as a present value is the value of the operating assets of the company. It's not the value of equity. You still have to subtract our debt. In fact, there's a lot of cleaning up to do to get to the value of equity. Now, I forced almost all of you into a firm valuation model. Okay. Now, some of you might say, I'd rather value the company than you'll get your chances if you decide to go down the valuation route to value equity. But you're going to discover that if you're uncertain about things, it's always better to value the entire business because all the levers are under your control. So let's summarize, and this is a slide from the last presentation, but since it came to the end, let's focus in on what the present value that you get from discounting cash flows will tell you. If you discount dividends back at the cost of equity, you're done. The value of equity is given. If you discount free cash flows to equity back at the cost of equity, and especially if they're aggregate free cash flows to equity, you get the value of the entire equity in the company, which you then have to divide up between the common stockholders and the option holders. That's what the management options do. If you discount cash flows to the firm at the cost of capital, your work is just beginning. Because you have to do the following. You have to add back cash. Why? Because you haven't valued it yet. It's not part of operating income. You also have to value minority holdings in other companies. Think Yahoo Japan and Alibaba whenever you think about minority holdings, because that will remind you that these are not always small numbers. Then you got to subtract out debt. That's the easy part. But you also have to subtract out the portions of companies you might have counted as if they were your own. Let me explain. When you own 55 or 60% of a company, you're required to consolidate. What does that mean? You have to act like you own 100% of the company. It's a really stupid accounting practice. And accountants, because they make you consolidate, will now have to tell you to deal with the 40% that doesn't belong to you. That's why you'll see minority interest on the balance sheet, on the liability side of the balance sheet. It's not a good thing. It's what you owe. Okay. Again, it's not a big deal in this class if you forget it, if you let it slide. But when we get to valuation, we're going to focus on this cross-holding component, because lots of bad things can happen if you're sloppy in this process. And what you get is a value of equity. Again, you have to subtract out the portion of that equity that belongs to managers, the equity options. You get a value of equity in common stock. You divide by the number of shares. And here's something I didn't ask you to wrestle with. When I divide by the number of shares, if I'm looking at Facebook, you know the problem I'm going to run into? You have two classes of shares. You have voting and non-voting shares. For purposes of this class, I said just add the two together. But you know already that the voting shares should probably trade at a premium over non-voting shares. How much of a premium? We don't have the mechanics to do that yet. But we'll come back and talk about it later when we talk about actually valuing companies with many classes of shares, which is actually more the rule than the exception outside the US in many parts of the world. So let me use the Disney valuation, because I hit you at the very end of the last class to kind of bring this process together. So in my valuation of Disney, I used a 10-year growth period. Why? Because I think Disney has strong brand names. I broke the 10-year growth period into a high growth phase and a transition phase. The high growth phase is where I did much of my work, because those numbers I reflected the status quo, existing cost of capital, existing return on capital, existing reinvestment rate. Why? Because Bob Iger is running the company, not me. And I might think the optimal debt ratio is 40%. I might think they should reinvest more, but it's irrelevant because the existing company is run by the existing management. Remember I said valuation is you're looking at companies from the outside in. Think of Disney as being inside a big glass bowl, and I'm looking through from the outside of the bowl at the company. The first 5 years, it's a status quo. Beyond year 10, I make Disney a mature company. What does that mean? The growth rate has to drop below the risk-free rate, 2.5%. I've got to give them the return on capital of a mature company, which means I've got to pull it towards a cost of capital. I give them a cost of capital that's more sustainable as a mature company. So after year 10, essentially they have all the characteristics of a mature company. Lower growth, lower cost of capital, lower reinvestment rate, lower return on capital. It's a mixed blessing. And the transition period I just used to adjust my numbers from what they are in the high growth to the stable growth. So when you looked at my Disney valuation, as I said, this is basically everything we've done in the class captured in one value. And that's really true. Everything you do in corporate finance is somewhere in a valuation in some number. If it's not, you're wasting your time on something you shouldn't be wasting your time on. So the growth rate doesn't come from what I like the company to grow at. It comes from how much they reinvest and how well they reinvest. So can Disney change its growth rate? Yes, by changing its reinvestment rate or changing its return on capital. The cost of capital I give Disney comes from their choices on debt and equity, the business they're in, and a lot of that is outside of their control. So that equity risk premium reflects where they do business. The beta reflects the 5 businesses they're in. The risk-free rate reflects the currency choice I made. What it effectively gives me is a shield, because when you do valuation, people like to say, well, I'd like to use a higher growth rate. And if you just made up a growth rate, you're completely defenseless, right? So if you used 8%, say, why don't you use 12%? How do you fight that? But if that 8% comes from what companies do, you turn it back on them, say, you want me to use a different growth rate, tell me what you'll do differently. So that's the base valuation, or base case valuation. I'll explain why I call it a status quo value. And the reason I call it a status quo value, and many of you when you value your companies have done a status quo valuation, is you've essentially valued the company run as is, which could be very well or very badly. That's input into your valuation. Okay. So let's see what you found in your valuation. I asked you for 2 numbers. I said, what's your price per share and the value per share? And I mentioned last class how when you first start doing valuation, the price acts like a magnet saying, come on over, come on over. And let's face it, when you first got a value of 27, the price was 65, you say, I must have done something wrong. I won't ask you those secret questions, but you tweak the revenue growth, you'll increase the margin. It happens. Everybody does it, at least initially. At some point in time, you have to have the confidence to be able, but right now I wouldn't expect that to be the case. In fact, I do a very simple test of how confident you are by the collective variation of the market price. And maybe if you're in my valuation class, I'll show you how different your prices get from the value after the valuation class than in this class. But you did find some misvalued companies. Your average company is overvalued by 63%. But before you freak out, that's because you had a few really overvalued companies. The median overvaluation was about 10%. In fact, I've compared, I took every second year and put it in here. And I wanted to start with spring of 2008 to see if you have some incredible foresight of crises coming. And the answer is not yet. Okay? Because if you did, what you should see is spring, I'd have loved to show you, spring of 2008, everybody found stocks to be overvalued. I should have listened then. You're not quite there yet in terms of being able to bring that insight in. And I don't think that's something you should be looking for collectively anyways. You have to value companies in the world you're in, not the world you wished you were in. So basically, you can see the distribution across the group. Now, let me go back to value, because the whole reason I bring value in at the end of a corporate finance class is the objective in corporate finance is not just maintain value, it's to increase value, right? And if you think about the drivers of value, there are 4 drivers. There's the cash flows you get from existing assets. There's that expected growth rate you're going to get in the future, your cost of capital, and when your company will be a mature company. Everything you do in business is going to show up in one of those 4 places. So when you talk about restructuring a company, you're really looking at those 4 inputs and say, what can I do differently in this company to make it a more valuable company? So let's start with cash flows from existing assets. I make you the CEO of a company. You come in, you look at the existing assets, and you see some existing cash flows. You say, how can I make those cash flows higher? So essentially the question I'm asking is, how efficiently am I running my existing assets? So if your factories are running at 60% of capacity, or you're doing something inefficient, fixing those inefficiencies will show up as higher cash flows from existing assets. So that's your first job. And if I make you the CEO of a mature company, this is where you're going to spend the bulk of your time. So when you hear about cost cutting and more efficient operations, what you're hearing is basically, how can I make the cash flows in this company higher than they are existing? The second stop you're going to make is, can I create more value from growth? Remember, the way I phrase this question is not, can I grow faster? You can grow faster, it's easy. Just go do 5 acquisitions. But remember, growth by itself doesn't create value. It's growth with excess returns. So can I create more value from growth? And there are 3 ways you can do it. The first is, maybe you can reinvest more in projects that make more than your cost of capital, increase your reinvestment rate. The second is, maybe you can pump up the return on capital on your new projects, which increases your growth rate as well. Okay? But the third is, maybe the best thing for you to do is to actually reinvest less. You know when that's going to be the answer to creating value from growth? If your return on capital is 5%, your cost of capital is 9%, the company is reinvesting a lot. It's destroying value. Lowering that reinvestment rate will actually increase the value of your company, not reduce it, because even though the growth rate goes down, your reinvestment will go down even more. Your value can go up. And third, I'm going to ask you, can you lower your cost of capital? And the answer is, of course, right? Because this is a corporate finance class. We talked a whole, 5 sessions about it. By changing your debt mix, but that's not the only way, right? You can change your debt ratio. What else can you do to lower your cost of capital? Match your debt up to your assets. That's the whole idea behind getting because that reduces your default risk. You can make your product or service less discretionary. How does that help you? If you make your product or service less discretionary, your beta drops off. So if you can somehow take something that's 67th on the list and move it to 35th or 12th or 11th or 5th on the list of what people have to buy, you've lowered your beta. Or you can reduce your fixed costs. So don't forget those 2 layers of betas as well. So really there are 4 things you can do that lower your cost of capital. And then I'm going to ask you, is there something you can do to put off the day when you become a mature company? Remember, every company at some point in time is going to be a mature company. But I said great companies are able to put it off for longer than good companies. This is where everything you do in corporate strategy, if it has a purpose, hopefully, this is where it should show up. Because what I'm asking you, what are your competitive advantages and how long can you maintain them? Because the bigger your competitive advantage, the longer you can maintain them, the longer the growth period can become. Everything you do in any class at Stern has to be on this page. So I'm going to make an offer to every class that I will come in and do one session that connects your marketing class to value, your strategy class to value. Because ultimately it's there, right? Ultimately we have one shared mission. We want to create the most valuable business. Not the highest stock price. That's a different debate because that requires market efficiency. The most valuable business. Everything you talk about in business has to be here. You're saying, what about corporate social responsibility? There is a place for it. In my valuation, you have to then show me that being more corporate, by being more responsible, socially responsible, it has an effect on my cash flows. Maybe that's what sustainability is. I don't get into as much trouble. My crises are small. I don't have the feedback effects of being a bad corporate citizen. I can value corporate social responsibility. And it's also, I think, a device for removing the bullshit we get stuck in. There's so much in business. We end up debating. We step back and say, what difference is this going to make to my... And if your answer is, I really don't see an effect, why are you wasting your time spending, 3 classes talking about it or 6 classes talking about it? Use it as a way of getting focused, because in business, you have enough to worry about without getting distracted. Use it as a way of getting focused. So I have my 5 companies, right? At least I can look at them now and I can think of that glass bowl. I'm going to open up the bowl and I'm going to go into the bowl. I'm going to be CEO for it. It's great for your ego. Try it out. So you know your company. Say, if I ran this company, Buffalo Wild Wings, I'll do things differently. For some reason, you guys love food companies. You're either fixated on eating or they were just there. A lot of food companies, So you can go in and change your company. So I took Disney and I said, what would I do differently at Disney? So think of this. Remember the status quo valuation with Bob Iger running it? This is Disney with somebody else running it with a different template. So basically, when you look at the valuation, here's what I changed. First, first I changed the debt ratio from 18% to 40%. Why did I pick 40? It was my optimal. I didn't pick it because it was the industry average or the target. So that's the advantage of doing this after you've understood the company. So you could think of doing this. You don't have to add this to your project. Please don't go freak out, right? But if I asked you what would this company look like if it were restructured, you could move your actual to your optimal. That'll lower your cost of capital. Then I went to the top and I looked at the reinvestment rate and return on capital they have right now. And I said, well, maybe they can reinvest more. I've got to be realistic. If they reinvest more, they probably have to take some projects that earn less than what they're making right now. But if I can find a combination, in fact, here I used a 50% reinvestment rate and a 14% return on capital, as opposed to a 54% reinvestment. So basically, reinvest less, make it more selective, but reinvest better. What I get is a slightly higher growth rate, not a big change, but it's going to have an impact on my value. So I changed my debt ratio. It's not big changes, right? Why? Because Disney in 2013 looked like a pretty well-managed company. Can you imagine what this would look like if I gave you Hewlett-Packard? You could look at every input. If I ran it, anybody ran it. A homeless guy came in and ran it, he could run it differently. Right? Because in a sense, each input is off what you'd expect it to be. The more badly managed a company, the more each cell is going to be open to you saying, if I did this, I would do things differently. So I put those changes in, I worked it through. I got a value of $74.91. Just to give you a comparison, the status quo value was $62.56. The value I'm getting with my changes put in is $74.91. That's about $12.35 higher than I got with the status quo value. So what should I call that increase in value? Where does it come from? My controlling the company rather than... This is the value of control. We make it this mysterious 20% variable. The value of control in your company is really the difference between two values. The value of your company as is, which is what most of you have turned into me, And the value of your company, and you don't have to do this for this project obviously, but if you wanted to, you have the inputs to actually revalue the company, saying if this company were run differently, what would the value be? And you get a value of control. And that number can range from 0. When will that be the case? If you have a company that's already perfectly managed and perfectly run. If you are awestruck at every step of the project of how well your company is run, you have a very, very unusual company. Let me know what the name of the company is. Then you might say, look, there's nothing I would change about this company. This company is incredible. But in almost every company, even the greatest companies in the face, there's always a weak link, right? A blind spot that every management has. It could be that they don't like to borrow money, even though they can afford to, or they don't like to return cash. If there's a blind spot, it's an opening for you to value control, but the value control will be less for well-managed companies, larger for badly managed companies. Now, of course, when you get a value that's different from the price, you think, what's going on? Because in a big chunk of your companies, the value is different from the price. And I mentioned this at the start of the valuation session, is most people price stocks. They don't value stocks. There's a pricing process and a value process. The value process is what we've just gone through. The pricing process is demand and supply. What drives it? God only knows. And if you're asked to price Disney rather than value Disney, you shouldn't be going through a discounted cash flow valuation or an intrinsic valuation. You should be pricing Disney. You think, what does that mean? You price a house based on other houses in the neighborhood, right? You price Disney by looking at what people are paying for other stocks like it. This is what pricing basically is. It requires you to come up with a group of companies, and there's no strict rule here as what that group of companies has to be, because it depends on who investors are comparing you to. So if you're Zillow, they're not comparing you to real estate companies. They might be comparing you to technology companies. You have to look at first what companies you're being priced against and how people are pricing those companies. I think at least 3 or 4 people valued Facebook. Anybody here value Facebook? Don't want to admit to it? No. But let's say you valued Facebook. You can go through the cash flows, the growth rate, and come up with a value for the company. That's a valuation of Facebook. But if I ask you to price Facebook, it's a very different process, right? Who are investors pricing Facebook against? Maybe Google, but maybe also the other social media companies, Yelp, LinkedIn, etc. So the group of companies you're comparing Facebook to might be companies that investors think of as comparable companies. How are they pricing these companies? The only way to find out is to look. So one of the things I did when I priced Twitter as opposed to valuing Twitter is I pulled up all the social media companies. I pulled up their market caps for every company. Then I pulled up every variable I could find in the company, revenues, EBITDA, etc. And then I did a correlation between the market cap and the different variables to see what variable best explained different. So the question I'm asking is not what's the right variable to focus on, but what's the market focused on. The variable that had a 98% R-squared with market cap was, what do you think it was with social media companies? It's number of users. At least in late 2013 when I did this, you tell me how many users you have, I'll multiply by 100, you got your market price. Because that's what the median price was across social media companies. Markets were paying 100. You're saying that makes no sense. What you and I think makes sense is completely irrelevant. If people will pay more for houses with more chimneys, then I'm going to build 15 chimneys on my house, even if I have I don't care whether there's a fireplace, just build chimneys. You're saying that's absurd. They're paying for chimneys. The same thing here. People are paying for users. You're going to supply. And that's what a lot of social media companies ended up doing, right? But the problem is at some point in time, the truth will rear its ugly head. I call this the bar mitzvah moment. The market says, hey, users are nice, but when are you going to start making money? And of course, the social media companies, you want me to make money? I thought users was all you wanted. And the thing about Facebook is the one social media company that's always recognized that even if the market's focused on users, they have to have a second channel open to convert those users into revenues and operating income and value. And that's why Facebook is worth what it is and Twitter is worth what it is. Okay. So when you think about pricing, it's a different game. Get your mind out of the intrinsic value game, get into the pricing game. And you can already see why traders and investors, traders play the pricing game, investors play the value game, often can't even talk to each other. Because they're talking different languages, they're talking about different processes. So I trolled through your list of companies and I took your price and your value. So this is back on you. So this is like one of those things where I have to put a disclosure statement at the bottom where I said, this is not my fault, these are just your numbers. So don't do anything crazy. If you do, it's not my fault, right? So these were your most undervalued stocks. Some of the currencies are obviously off because I didn't have the time to actually, so the Sony, for instance, is in yen. That's why it's so big, right? But the last column, I basically picked the companies that were most undervalued on a percentage basis, and this was your list. Okay. Again, I will, the judgment you have to pass will have to depend. The ultimate judgment is, what question I'm going to ask you before I buy the stock you told me was undervalued? I'm going to ask, are you buying? And if you say, no, I'm still uncertain, hey, you know what? Nice undervaluation, but I'm not going until you're going. So you jump first, I'll jump after you. That is the ultimate test in valuation, is are you actually willing to stand behind those numbers? So maybe when you get a chance, if your company's on this list, just email me and say, I'm buying, and don't lie to me, please. I have my ways of finding out. Yeah. So that's the ultimate test. Then I did one final screen, which I've done every semester. I call this my triple whammy list. These are companies that first, take good projects, they have returns on capital that exceed the cost of capital. Second, are under-levered. Third, pay out less in dividends than their free cash flow equity. So basically, they have good projects, they have debt capacity, and they're holding back cash. You see, so what? And they also happen to be undervalued. If you're targeting, let's say you're an activist investor, you're looking for undervalued companies, right? That's your first strike. Second, you're looking for companies where you can change something. Capital structure and dividend policy, I'm giving that to you on a plate. Okay? Essentially, that's, if I were an activist investor, this would be a list of companies I would think of, hey, these are companies I should be targeting because there are lots of ways in which I can increase value at these companies. Okay? And there are a couple of companies that show up more than once on the list. Apple, I think, shows up 4 times on the list. So I get it. You should show up. If you're doing Apple, same things kind of drive this discussion. So let me finish with that page I started with. Remember, corporate finance is all about maximizing the value of the business. 3 big principles: the investment principle, the dividend principle, the financing principle. Let me restate the principles. Hopefully they have a little more heft now than they did in the first session. I said, if you're a company, you want to go out and invest in projects, invest in assets that earn a return that is greater than some minimum acceptable hurdle rate. And that time it was just a buzzword if you'd never taken a corporate finance class. But hopefully there is something to that hurdle rate now. The hurdle rate should reflect the riskiness of the asset or business. That risk is measured with a beta with equity and with a default spread with debt, and that shows up in the hurdle rate. It should also reflect the mix of debt and equity used. That shows up in the weights used in the cost of capital. And it should measure returns. For if you're using a shortcut, that return can be measured as a return on invested capital. But if you have actual cash flows, you want to make sure the present value of the cash flows exceeds what you would get, what you would have to make as an initial investment. So that's the investment principle. Go out there and take good projects. The second stop is find a mix of debt and equity that's right for you and choose debt that matches up to your assets. That's the whole idea behind looking for the optimal mix and what the right kind of debt is. And the third piece to the puzzle is your dividend principle, which is if you cannot find investments that make your hurdle rate, give the cash back to the stockholders. Now you might say you have a temporary phase where that's happening, you might hold back cash, but at some point in time that decision has to be made. And in doing all of this, your end game is you want to maximize the value of the business. I'm going to close with a couple of very simple propositions about corporate finance. And they actually go back to my original objectives for this class. If you go back and look at the first class, you'll see these listed, my 3 objectives. I'm not sure I accomplished my objectives, but I said first I want to give you a sense of the big picture. And really corporate finance is about perspective. It's constantly stepping back. I call this elevating. You step away from your company, because when you get stuck in the details, it's very easy to get stuck in the details. So what should I include in working capital? Should this item be there? That's natural. But once in a while, maybe lots of times, you need to step back and say, does this even matter? Should I be spending my time here? That's the big picture perspective. And that's why you constantly have to look at the company as an organism, where you can't just talk about capital structure, dividend policy, investment analysis. They're all connected. The second, we've talked about lots of tools, right? Cost of capital as an optimizing tool, free cash flow to equity. But ultimately, you get to use those tools, and you have to know first which tools to use, when to put them away, and when to override them. Okay? Because if tools gave you what companies should do, then none of us need to be here. I mean, this would be an automated process. And third, I said corporate finance is fun. At this point in the class, I will not go there, because I'm sure it doesn't feel like fun after losing a night of sleep and having to churn out a project and a final exam coming up. You know. But it's not that bad, is it? I mean, it's, you know, and it can get to be fun once you take that pressure off. Okay? And if you're thinking about electives to take in corporate finance, I have some bad news. You're done. This is it. There's really, in corporate finance, there's really nowhere else to go. You have everything you need. That doesn't mean you've mastered corporate finance, but to master corporate finance, here's what you need to do. This is going to sound like torture, but here's what you need to do. Wait till this class is over. That's critical. Wait till the other exams are done. That's even more critical. Then pick a second company. A company as different from the company you did in this class, and take it through the process you just went through. Then take a third company. You think, why would I want to do this? Because you learn corporate finance by doing. Everything I've learned about corporate finance has come because I've gotten stuck in a company and say, I've never seen this before. And what you then have to do is devise solutions by going back to first principles. So that's why I cannot give you the solution to every problem you're going to run into, because I have no idea what problems you're going to run into in individual companies. But the only way to learn whether you're getting those first principles is to get entangled in a company and try to answer those questions yourself. A little bit about the final exam. Kind of quieted people down. Okay. It is on Friday. If you're taking the regular final, the early final is 1:30 to 3:30 on Wednesday, right? Which creates a bit of a problem for my review session, because if I do it on Thursday, it's too late because I think 20% of the class is taking it on Wednesday, 80% is taking it on Friday. So the review session is going to be, and this is the bad part, it's going to be tomorrow, because I want to get it done before both groups do it. So it's going to be 3 to 4 tomorrow. You might not be able to make it. I think there are no classes tomorrow, right? But even if you're not able to make it, you know, it will be webcast and on YouTube and et cetera, iTunes U, et cetera, wherever you want to watch it. Okay? But it'll be 3 to 4 in KMEC 260. Okay, so the review session is tomorrow for the final exam. I will send out the presentation for the review set, the slides for the review session after class today, with the seating chart for Friday as well. The second is a little bit about the final. And if you've looked at the past finals, which most of you probably haven't because you haven't had the time, you've been working on the project, it's a pretty set format. There are 5 questions, and here's what the questions will cover. The first question will cover beta, cost of capital, cost of equity. The second question will cover investment analysis. The third question will cover capital structure. Kind of pretty much the whole class. It's a comprehensive class. But here's the key part. The last 2 questions will cover what we've done since the last quiz, which is really only, 4 sessions or 5 sessions. So the 4th question is always a dividend policy question. The 5th question is always a valuation question. They're all equally weighted. So what I'm suggesting is, as you start reviewing for the final, work backwards. Work backwards in the sense, get the dividend policy and the valuation, because I know, especially if you took the first 3 quizzes, you'll feel the urge to do things sequentially starting. Don't do that, because if you get stuck 60% through the class and you don't get to dividend policy and valuation, you've left a lot on the table. And in the process of doing valuation, you're going to revisit levered and unlevered, all the things that you kind of thought you'd left behind you. But start and work backwards, because that's going to be 40% of the final exam. It is open book, open notes. It's a 30% final, unless you missed one of the quizzes, in which case it is going to be weighted more because the scores got moved up to the final exam. I'll also send you a spreadsheet after this process where you can put the numbers in right after the final, where you can put numbers in and see how you, because I know some of you are still confused as to what happened to your worst quiz, so you'll be able to see exactly what happened to your worst quiz in terms of the score it got replaced with. You know. So that'll happen after class today, so if you get that seating arrangement, it'll be for Friday, early quiz. If you still want, there are still spots available for, I'm not trying to sell it. Okay. There are about 60 people signed up for the, so there are about 20 more slots available. So if you need to still take it on Wednesday for whatever reason, just go in and sign up. One final thing, I think the CFEs start, you know what the CFE, don't look at me like, what's a CFE, right? Yeah. I have a very, very selfish interest in you filling out your CFEs. You know what happens if you don't fill out your CFEs, right? What happens? You cannot check your grade. Now here's the selfish part that kicks in. When you cannot find your grade because you forgot to do your CFE, guess who gets emailed? It's me. So please get your CFEs done, if nothing else, to take that load off my shoulders. One final point is actually the CFEs you're looking at now are a lot less painful than they used to be. I was actually on the committee that redesigned the CFE. They didn't take my suggestions fully because I came into the first meeting saying, I've got an idea, here's what the CFE should look like. So if I had my druthers, here's what the CFE would look like. And unfortunately, this is not the way it looks like for you. But basically go in, it's 8 questions, circle. I don't care if you do it randomly, if you do it, whatever is easiest, quickest, get it done. I don't care, right? So fill out your CFEs, and as you fill out your CFEs, I'm going to leave you with a story about my very first corporate finance class that I taught. It was the fall of 1984. Okay. And I was teaching at UC Berkeley. It was a class called BA 130. It was the undergraduate corporate finance class. First time ever I taught a class. So it's 10 weeks long, it's a quarter. So I go through the class, CFE time. In those days, you actually filled out the CFEs in the last class physically. And now I was really curious. I said, make sure you tell me what you'd like to change about the class. A practice I've completely abandoned since. Okay? And of course, I get all the comments back, and I read through them. There were 150 people in the class. I'd read through every comment because I wanted to find out. And here's the comment the only comment I remember from the entire class. So remember, this is UC Berkeley in 1984. The person says, wear more earth tones. So my response was, I'm an earth tone. If I wear more earth tones, you won't even be able to see me, right? So I don't like earth tones. I still don't wear them, as you probably well guessed. So if that's your comment on my CFEs, what I should be wearing, I probably won't read it anyway, but you can put it in if you want. No? But thank you so much for hanging in here. It was, I know it was a lot of work, and hopefully it'll pay off. No? Thank you. That's it? You're done? Probably about I would think less group work, more individual work.
What's the purpose for this course? Investment banking?
Anything you want to say? It's not really designed for investment banking. It's really designed to run a business.
And the build to this.
The valuation class is all about attaching the value to a company, which everybody needs. Startup business is needed because entrepreneurs need a value, venture capital is needed, private equity investors need it, businessmen need it. So it's just a tool that everybody needs.
So for example, if I'm going to work for a startup in the summer and they just finished their B round fundraising, which part of corporate finance knowledge can I use to help them?
You can only the valuation part, but every part is, they have to make investment decisions, right? I mean, they have to make it.
They just finished the fundraising.
Fundraising means they just have the money. They have to invest the money, right?
Right.
So that's an investment decision. The financing decision is out of their control. They have to use all equity. They have no choice.
Right.
The dividend decision is off the table because they need all the cash they need, but it's all investment right now. So you have to decide where to invest the money, how best to invest the money, and if you can help them on that, that'd be great.
Thank you.
Hey, how are you?
Quick question. So first of all, one of our companies is Tesla.
Yeah.
And I know they're a money-losing company. Can we still include them?
Yeah. So you've got an optimal debt ratio of 0 and you can't pay dividends,
Correct.
right? So as long as you're...
Because I thought we weren't, I heard you say we weren't supposed to include money-losing companies.
Yeah,
I
that was
find
that
it
was
interesting because our valuation is about 1% different than the share price.
Yeah.
So
the valuation part of the investment analysis part work. What happens to your capital structure and dividend policy, you run into dead ends very
I
quickly.
have another question
Yeah.
about debt holdings. So the actual timing or duration of the type of debt that one of our companies has is all fixed rate, but then they invest in all these swaps that
So they're
change.
potentially, yeah.
So in reality, they're not all invested in fixed rate debt. So is there any benefit to, when you do that, getting out of the swaps and instead
Yeah, if
issuing
it's a
the
continuous,
actual
if it's a
type?
continuous exposure, you should not be using swaps because those are temporary exposures. So that's a question you have to ask: is this exposure that I'm computing for them a permanent exposure or a temporary exposure? So you have one contract in Australian dollars next year. Of course, you should use a derivative. But if you have 30% of your revenues from Australia because you have a mine there, you shouldn't be using derivatives. You should actually be using Australian dollar debt to fund that. Right? So it really depends on whether the risk you see is a permanent risk or a temporary risk.
Right. Okay. All right.
Okay.
Thank you.
Good. Hey, how are you?
Hey, I'm good. So a quick question of corporate governance. So my particular company had a lot of, basically it was majorly owned by MHR. I remember this one slide that you were mentioning that a lot of these institutional investors tend to vote with the company rather than against it. But in one of the analyst estimates there, right, it said that because MHR owns more shares, they have a more tighter hold on the company and they discipline the company.
That's MHR is not an institutional investor, right? It's a holding company.
Right. So
Holding,
all right.
holding companies are not institutional investors, right?
Right. So
It's
in
like
that,
Tata Group controlling Tata Motors.
So if there are holding companies holding majority of shares, do you think they exercise more control over the company or like dictate?
Yeah, anybody who owns a lot of shares is going to, how they exercise control will vary
All right.
depending on what they're trying to get out of the company.
All right. Just last question. I had a revision on my first quiz. I think I sent it to you. So will I see that reflected in the sheet that you sent today?
The first, what did I say?
So the first quiz,
Right.
I had a half a mark point increase.
When you say sheet that I sent today, what would that be?
No, I thought you were going to send the score sheet.
No, it'll just be a blank sheet. You have to enter your numbers. So it won't give you your scores.
All right.
Right. So you'd have to enter the scores you actually got. So, so if you want to email me and check on the score, whether I change the score, you can do that.
Okay. Thank you.
Hello, Sanam. How are you? You're welcome.
This is wonderful.
Thank you.
I have a valuation question, but I already submitted, and I can email you.
No, you can ask me now.
So, I'm curious, when your marginal investor is an insider and you use total beta and everything's brought up from that, when you do valuation, it kind of just dawned on me. I subtracted out my equity my options, and if I'm using a insider's cost of capital and they have the options going to them themselves, then I wouldn't subtract it out to
You
get.
still would get a share price, right? Because what you're computing is what would I pay for a share if I'm not an insider. That's
Is
what you're
that
computing.
it? Okay,
That's
because
what you're
that's what I
computing,
wanted
right?
to
That's what
ask.
you're getting. Because in a sense, if you are interested in the company, you're not an investor. You're looking at the share price.
Sure.
The question you're asking is that share price an attractive price for me as an outside investor?
And so it's somewhat compensating for the risk of a lack of independent corporate
Yeah, because you covered it two ways. One is by using a higher cost of capital, you've built in the fact that insiders will run the company for their
Right.
favor, which lowers the value of the company to you as an outsider.
So
No. and the options they've granted take out of your equity, which lowers your value even more.
Right. So can you calculate what if I were Richard Sands
Right.
sitting in,
You still
what the
get,
value would be
it's a
to me?
you can value the equity stake they have in the company, which is a collection, which is a combination of the common shares they own times the share price,
Right.
plus the options they have in
Sure.
the company. Right. So you can go. So that's, you don't think on a per share basis. You think about your equity holding in the company and how much it's worth, because ultimately, that the dollar value, you really don't care how much comes from options and how much from common stock. We have, so basically, it's a collective value of equity that you get,
Right.
from the options and from your common shareholding.
Okay. All right. Thank you.
Okay.
Okay.
Like, take care. Yeah.
Thank you. Thank you for the help before.
You're
also
welcome.
With like, helping me set up with Charlotte. We went a few times before the quiz, so it was helpful. Do you know if they're still doing are they doing a review this week?
I'll check with them.
Okay.
Yeah.
And so
Because they have finals too, right? So,
I was trying to think about my final grade. Is there usually a curve at the end?
yeah, there's always a curve at the end.
So do you know about how much out of 100 that would be worth? Like, let's say, for example, 'cause I figured out what
To get to what?
So I figured, assuming I get, we did well on the
Right.
previous one, we got 95, 9.5. But assuming we get an 8.5, which I figure is average on this one, I'm just pulling it up.
Mhm.
I figure I need to get a 90 on the midterm, on the final, to get a 80 in the class. Because my first two, my top two other quizzes.
No, because you get a 20, if you get a 20, let's see, what the final also has an additional
Right.
flipper that it creates, which is we get over 22, 23, you automatically a B class. If you get over 20. So there's a secondary layer that can push up your grade. So I call this the final exam override. Or if you get a 30 in the final, you automatically get an A. No matter what you walk in the final with, you get a 29, it's an A minus. A 27 is a B plus. A 24, I think. So basically, there are these additional
I'm
overrides.
assuming no flipper. I mean, what would the curve, what does the curve usually come out to?
80 would give you probably B minus, B. So,
So
if you
theoretically,
just have an 80 with, yeah.
So theoretically, like a 75 would probably be like a B minus.
Yeah.
Okay. Just trying to think. I mean, hopefully, I'm assuming to get the flippers 23. You said.
23. Yeah.
23. Okay, great. Thank you.
Okay.